Every financial scam in history has one thing in common: not greed. Every industry has greed, not complexity. Some of the biggest frauds in history were extraordinarily simple, not the absence of warning signs. Almost every major financial fraud had visible warning signs that people chose to ignore. The one thing every major financial scam shares is this: the victims trusted the person who was stealing from them. Not blindly, not foolishly, with good reason, based on real evidence, based on real credentials, based on real track records that were either genuine or meticulously fabricated. Today, Max counts down the 5 biggest financial scams in recorded history, not as a list of crimes, as an investigation into the architecture of fraud itself. Because understanding how 5 completely different scams in 5 completely different eras across 5 completely different countries all operated on the same fundamental mechanism is the most important financial education available. If you understand the pattern, you can recognize it. If you can recognize it, you cannot be fooled by it. These 5 cases include the fraud that named all frauds after it, the scam that destroyed a nation's economy in a single year, the teenager who built a fake empire worth $200 million, the energy company whose executives convinced Wall Street it was the most innovative business on earth, and the case we investigated in video 12 that you now understand in a completely new context. 5 scams, 5 eras, 1 pattern. This is Follow the Money with Max. Let us count them down. Scam 5. The year is 1720. The place is France. And a Scottish economist named John Law has just convinced the French government to let him run what may be the most audacious financial experiment in history. France was effectively bankrupt in 1720. Years of wars under Louis XIV had left the country with enormous national debt and a population that had completely lost faith in the government's paper currency. John Law arrived with what seemed like a genius solution. He would create a company, the Mississippi Company, that held a monopoly on trade with France's territories in North America, including what is now Louisiana and the Mississippi River Valley. He would sell shares in this company to the public, and he would use the company's theoretical future profits from North American trade to pay off France's national debt while simultaneously giving ordinary French citizens a way to profit from the country's colonial expansion. The idea was not inherently fraudulent. The Mississippi River Valley was genuinely enormous and genuinely valuable. The potential was real in the abstract. The problem was the execution. Law's promotion of the Mississippi Company created one of the first documented speculative manias in financial history. Shares in the company that had originally been offered at around 500 livres rose to nearly 10,000 livres within months. The rise was fueled partly by Law's own manipulation of the money supply, printing paper currency to give people money to buy more shares, which drove prices higher, which attracted more investors, which drove prices higher still. The streets of Paris were reportedly jammed with people trying to buy shares. Servants became wealthier than their employers on paper. Ordinary people who had never owned a financial asset found themselves holding shares worth fortunes they could not previously have imagined. And then it ended, as it always does when asset prices lose all connection to underlying value. Investors began to realize that the Mississippi Company's actual revenues from North American trade were nowhere near sufficient to justify share prices that had risen 20 times from their original offering. The selling began. Prices fell. More people sold. Prices fell further. The spiral accelerated. Within months, the Mississippi Company had collapsed. The paper currency Law had printed to fuel the bubble became worthless. Many of the ordinary French citizens who had briefly been wealthy, on paper, lost everything. John Law fled France in disguise. France's economy was so badly damaged by the collapse that some financial historians argue it set the stage for the economic dysfunction that contributed to the French Revolution 70 years later. The pattern visible in the Mississippi Company bubble is the same pattern visible in every major financial fraud that followed it across 3 centuries. An authority figure with genuine credentials. An investment opportunity with a real but exaggerated underlying idea. A mechanism for generating visible returns that attracts more capital. The returns become dependent on new capital rather than real underlying value. And when the new capital stops flowing, the whole structure collapses. Scam 4. The year is 1920. The place is Boston, Massachusetts. And a charming Italian immigrant named Charles Ponzi has just discovered something extraordinary about international postal reply coupons. Postal reply coupons were certificates issued by the Universal Postal Union that could be purchased in one country and redeemed in another country for postage stamps. Because of differences in currency values after World War I, it was theoretically possible to buy postal reply coupons cheaply in one country and redeem them more expensively in another, earning a profit from the exchange rate difference. This was called arbitrage. And Ponzi's insight about postal coupons, while the specifics were more complicated in practice than in theory, was based on a genuinely real financial observation. He used this real but largely impractical idea as the basis for an investment scheme. He promised investors returns of 50% in 90 days, 100% in 180 days. These returns were genuinely extraordinary, even by the speculative standards of the 1920s. But Ponzi's initial promises were kept. Early investors received exactly the returns he had promised. Word spread. The money poured in. What Ponzi was actually doing was simple. He was paying early investors with money from later investors. No postal coupons were being purchased at any meaningful scale. No arbitrage profits were being generated. He was simply running what we now call a Ponzi scheme, paying existing investors with money from new investors. The mechanism that, 2 years earlier in France, had destroyed a national economy, now reappearing in the streets of Boston in a three-piece suit. At his peak, Ponzi was taking in approximately $1 million per week. He was investigated by the Boston Post newspaper. When the paper published its concerns, Ponzi immediately offered to submit to an independent audit, an audit that he was confident he could delay long enough to allow more money to flow in. The audit was not delayed long enough. The auditor discovered significant discrepancies in the accounts. The Boston Post continued publishing. Investors began withdrawing. Ponzi's scheme lasted approximately 8 months before collapsing. He was arrested, convicted of mail fraud, served time in federal prison, was deported to Italy, attempted subsequent schemes in Florida and in Brazil, and died in poverty in 1949. But his name lives on permanently as the descriptor for the specific type of fraud he popularized. And here is the important observation. Ponzi was not the first person to run this type of scheme. Sarah Howe had run a similar scheme in Boston in the 1880s. Adele Spitzeder had run one in Munich in the 1870s. The Mississippi Company a century and a half earlier had operated on a similar underlying principle. But Ponzi's version was documented in enough detail and publicized by a sufficiently prominent newspaper investigation that his name became permanently attached to the mechanism. Every Madoff, every Mississippi, every future scheme that pays existing investors with new investor money, they are all fundamentally Ponzi schemes. The name changed. The mechanism never has. Scam 3. The year is 1986. The place is Reseda, California. And a 16-year-old named Barry Minkoff has just started a carpet cleaning business out of his parents' garage. By 1987, when Minkoff was 20, ZZZZ Best, his carpet cleaning company, had gone public on the stock market and was valued at approximately $200 million. The company reported revenues in the tens of millions. It claimed to be performing large-scale carpet restoration work at major buildings, shopping centers, and commercial properties. The company's accountants and investors had received documentation, contracts, photographs, and testimonials supporting these revenue claims. Almost none of it was real. The large restoration contracts that made up the vast majority of ZZZZ Best's claimed revenue had been fabricated. The properties where the restoration work was supposedly performed did not exist or had never contracted with ZZZZ Best. The documentation was forged. The photographs were staged. The testimonials were invented. Minkoff had constructed what investigators would later describe as an almost entirely fictional business infrastructure, elaborate enough to fool professional auditors and institutional investors for years. He was eventually caught when a journalist investigated complaints from customers of the carpet cleaning business, the small legitimate portion of the company, and began pulling on threads that unraveled the entire fabrication. Minkoff was convicted, sentenced to 25 years in prison, paroled, and later convicted again on separate fraud charges. What makes ZZZZ Best particularly relevant to the pattern we are investigating is the auditing failure. Professional accounting firms examined ZZZZ Best's books and found nothing. Not because they were incompetent. Because Minkoff understood exactly what auditors look for and constructed his fabrication specifically to satisfy those lookups while hiding the underlying reality. He exploited the gap between what auditors verify and what auditors assume. Scam 2. Enron Corporation. Houston, Texas. The late 1990s and early 2000s. Enron was not an obscure company run by an unknown fraudster. It was named Fortune magazine's most innovative company in America 6 consecutive years between 1996 and 2001. Its executives were celebrated on magazine covers, invited to the White House, and held up as models of the new economy. What Enron had built was an extraordinarily sophisticated system of accounting manipulation that allowed the company to present a picture of financial health and growth that bore almost no relationship to its actual performance. The specific mechanism was called mark-to-market accounting, used in ways that went well beyond normal application of that accounting method. Enron was allowed, under rules it had specifically lobbied for, to record the expected future profits from contract immediately as current revenue, even before those profits had been earned or in many cases even before the underlying contract had generated any actual cash. When Enron signed a contract with a customer, it could book the total theoretical profit of that contract over its entire lifetime as revenue in the current quarter. When those theoretical profits failed to materialize, rather than recording a loss, Enron would create a new contract or a new financial vehicle to generate new theoretical future profits to offset the unmet expectations of the previous contract. The entire structure was an elaborate machine for converting future speculation into present reported revenue, while hiding the mounting reality of non-performance inside a labyrinth of off-balance sheet entities, special-purpose vehicles, and accounting complexity that most analysts and investors lacked the expertise or the will to penetrate. Enron collapsed in 2001 when it became unable to sustain the financial fiction. It was the largest corporate bankruptcy in American history at the time. Thousands of employees lost their jobs and their retirement savings simultaneously. The accounting firm Arthur Andersen, one of the largest in the world, was destroyed by the scandal. Its senior executives faced federal criminal charges. Enron is the clearest example in modern financial history of what happens when sophisticated accounting manipulation is combined with a corporate culture of aggressively punishing internal dissent and a regulatory environment that was both technically inadequate and socially reluctant to challenge a company with such extraordinary prestige and political connections. The pattern: real company, genuine innovation in its early years, accounting that increasingly departed from reality to maintain the appearance of continued excellence, and a social prestige that made institutional skepticism feel almost impolite. Scam 1. You already know this one. Or you think you do. We investigated Bernie Madoff in detail in video 12. If you have not watched that video, pause here and watch it first. The full investigation of how $65 billion disappeared for 17 years will make what follows more meaningful. But here is what the countdown reveals that the individual investigation of Madoff could not. When you see Madoff in the context of the Mississippi Company bubble, the Charles Ponzi scheme, ZZZZ Best, and Enron, the pattern becomes unmistakable in a way it simply is not when Madoff is examined alone. Every single one of these 5 cases had the following elements. First, a legitimately credentialed operator. John Law was a genuine economist with real theoretical innovations in monetary policy. Charles Ponzi had a real insight about postal coupon arbitrage, even if the practical implementation was impossible at scale. Barry Minkoff ran a real carpet cleaning business alongside the fictional empire. Enron had genuine early innovation in energy trading. Bernie Madoff built and ran one of the most respected legitimate market-making operations on Wall Street. None of these were purely fictional operators. All of them had a real core around which the fraud was built. Second, an investment proposition based on a real but exaggerated underlying idea. Mississippi Company, French colonial trade was genuinely valuable. Ponzi, currency arbitrage, was a real concept. ZZZZ Best, commercial carpet restoration, was a real and profitable industry. Enron, energy trading and innovation were genuinely revolutionizing the market. Madoff, the split-strike conversion strategy, was a real, documented investment approach. Every fraud in this list used a real idea as its credibility foundation. Third, an institutional failure that allowed the fraud to operate in plain sight. Mississippi, a government that needed the scheme to work and therefore refused to scrutinize it. Ponzi, financial regulation in 1920 Boston that was primitive by modern standards. ZZZZ Best, auditing procedures that could be specifically reverse-engineered and defeated. Enron, accounting rules that had been lobbied into existence specifically to enable the manipulation. Madoff, an SEC that lacked technical expertise, suffered from conflicts of interest, and gave undue deference to a respected industry figure. In every single case, there was a regulatory or institutional system that should have caught the fraud and did not. Fourth, the social prestige shield. John Law had the patronage of the French government and the personal support of the most powerful financial figures in Europe. Charles Ponzi had the legitimacy conferred by thousands of satisfied early investors. Barry Minkoff had the credibility of a stock market listing and professional auditor endorsement. Enron had 6 consecutive Most Innovative Company awards and political relationships at the highest levels. Bernie Madoff had a former NASDAQ chairmanship and client list that read like a directory of financial sophistication. In every case, the social proof surrounding the fraud was so overwhelming that skepticism felt irrational to the people most positioned to scrutinize it. This is the one pattern. Every fraud that has ever achieved massive scale has achieved it not by fooling naive, ignorant people, but by assembling a combination of real credentials, a real underlying idea, institutional failure, and social prestige that made the fraud feel safer than the skepticism required to see through it. So, how do you recognize this pattern before you become part of the next version of it? Because there will be a next version. There has been a next version in every decade of recorded financial history. The Mississippi Company bubble led to South Sea bubble within the same year, an almost identical scheme that destroyed the fortunes of thousands of British investors, including the scientist Isaac Newton, who reportedly said he could calculate the motions of celestial bodies but not the madness of men after losing the equivalent of millions of dollars in modern terms. The Charles Ponzi scheme led to Bernie Madoff and to hundreds of smaller Ponzi schemes that have been prosecuted in every decade since 1920. Enron led to WorldCom, Tyco, HealthSouth, and a wave of accounting manipulation scandals that followed almost immediately in the early 2000s. The pattern repeats because the underlying mechanism never changes. Human beings are wired to extend trust to people and institutions that display the correct social signals of trustworthiness. And the people who build the largest frauds are, almost without exception, extraordinarily skilled at displaying those signals. So what does recognizing the pattern actually look like in practice? 5 specific questions. Question 1. Are the returns or the opportunity too consistent? Real markets are volatile. Real investment returns fluctuate. Any investment that reports unusually consistent positive returns without significant variation across market conditions should trigger intense scrutiny, not comfort. Consistency is a red flag, not a reassurance. This is what Harry Markopolos spotted about Madoff in 5 minutes. Question 2. Is the underlying mechanism fully explained and independently verifiable? If you cannot get a clear, specific, detailed explanation of exactly how the returns are being generated, and you cannot independently verify that explanation through third-party sources who have no financial stake in the investment, treat that gap as a warning sign. Genuine investment strategies can withstand explanation. Fraudulent ones require mystery. Question 3. Who is doing the auditing, and what exactly are they auditing? ZZZZ best taught us that auditors can be specifically deceived by fabrications designed around what auditors look for. Madoff taught us that a tiny, unknown accounting firm auditing a multi-billion-dollar fund is a red flag of the highest order. The identity, reputation, and thoroughness of auditors matters as much as the fact of auditing itself. Question 4. Is the social proof doing too much work? When the primary argument for trusting an investment is that other respected, sophisticated people have already trusted it, that is social proof doing the job that financial analysis should be doing. Smart people being wrong together has happened in every single case on this list. Question 5. What happens when you try to withdraw or ask detailed questions? A genuine investment has no reason to make withdrawal difficult or to deflect detailed questions about mechanics and performance. Any resistance, delay, pressure to reinvest rather than withdraw, or vagueness in response to specific questions is a fundamental warning sign regardless of how compelling everything else appears. These 5 questions will not catch every fraud, but they would have caught every fraud on this list. Every single one. Let us close with the most important observation. Every fraud on this list involved real victims who genuinely did not deserve what happened to them. Isaac Newton losing his fortune in the South Sea bubble was not a story about a foolish man. It was a story about one of the greatest minds in human history encountering a social and psychological mechanism that his extraordinary intelligence was not specifically equipped to defend against. The French citizens who lost everything in the Mississippi Company bubble were not naive. They were participating in a scheme endorsed by their government, promoted by the most respected economists of their era, and validated by thousands of other sophisticated investors around them. The retirees who lost their life savings to Bernie Madoff were not financially unsophisticated. Many of them had spent decades building wealth carefully and responsibly. They encountered a social and institutional environment that had been so thoroughly compromised by Madoff's prestige and the SEC's failures that skepticism had become almost inaccessible. This is the final lesson of these 5 cases. Financial fraud does not primarily prey on ignorance. It preys on trust. And trust is not a weakness. It is the foundation of every functional human relationship and every functional economy. We cannot and should not eliminate trust from financial life. What we can do is understand specifically where and how trust gets exploited at scale, so that when we encounter the 5 signals, a legitimately credentialed operator, a real but exaggerated underlying idea, an investment proposition that feels too consistent, a social prestige shield that makes skepticism feel impolite, and a regulatory environment that is either inadequate or captured, we recognize them. Not with paranoia, with pattern recognition. The frauds of the future will not look like Enron. They will not look like Madoff. They will look like the most trusted, most credentialed, most prestigious financial opportunity of their moment. They already do. Understanding the pattern is the only protection that works across every era and every version of the same underlying fraud. My name is Max. You have been watching Follow the Money with Max. If these 5 cases and the pattern connecting them changed how you think about trust and financial fraud, share this video. Because the next version of this fraud is almost certainly operating right now. And the people who can recognize the pattern are the people who will not become its victims. Subscribe. Because the next Follow the Money investigation takes everything we have built across 15 videos, the money laundering, the Ponzi schemes, the billionaire tax strategies, the stealth wealth, the shadow economy, and uses it to answer the question you have probably been building towards since video 1. How do rich people actually think about money differently from everyone else? Not the tactics, the psychology, the specific mental frameworks that separate the people who build generational wealth from the people who do not. That investigation is next. Subscribe. Follow the Money with Max.